Hello guys, welcome to another video. I'm super excited about this one today. We are going to be looking over backtesting and algorithmic trading strategy using Python. Specifically, we are going to be looking into the simple moving average crossover strategy. This is an elementary version of a more complex trading signal strategy that I actually also use to give me additional support from my entry and exit points when I'm doing my options trading. And in this video, we will be breaking it up into 4 parts. I will be giving you an introduction to what the simple moving average strategy is. We will be looking over the coding piece and backtesting the entire strategy, which you can also do coding along with me. The link will be down in the description below. Thirdly, we will be reviewing the results of the strategy and going over whether it's worth it, what it would be like comparing it to a buy and hold strategy, whether it should be more short-term or long-term, what the results would be like. And at the end of this video, I got a little surprise for you, as I'm going to be giving you an update on what's coming next for this channel. So stay tuned for that. Before anything, I would like to give a shout out to everybody who has liked and subscribed this channel so far or followed me on any of the social media channels. The links are all down in the description below. And if you haven't done so far, please drop me a like or click that subscribe button. It helps me a lot with the YouTube algorithm. And if you have any suggestions or you would like to see something in a future video, please drop a comment down below. I will make sure to read it and to answer it as well. All right, guys, let's get into it, shall we? So before we start, I need to do a little toilet paper disclaimer. This video is no investment advice and is only for educational and entertainment purposes. Trading may bear significant amounts of risk and may result in the total loss of your invested capital. Do not follow blindly the results of the script we are about to analyze. Losses are a part of trading. That's the reality. And if you want to read it for yourself, there you go. Take good note of that so you don't end up in the
shit's gonna hit the fan.
So let's move on, shall we? So, simple moving average, or SMA for short, is essentially taking a bunch of prices from a range of periods and taking the mean price from that range. It is used to determine whether a certain asset price will continue in its trend, whether it's an upwards trend or a downwards trend, or whether that specific trend is about to reverse. And two very popular ones are the 50-day simple moving average and the 200-day simple moving average, because those, when they cross over, they give us either the golden cross or a death cross pattern. The 50-day moving average versus the 200-day moving average is essentially quite a lot quicker, since it places a lot more weight on the more recent price changes, whereas the 200-day simple moving average reacts a lot slower, and as such it represents more kind of the longer term trend of the asset that we are analyzing. For the market, when the 50-day and the 200-day cross over, this is quite often interpreted as a trading signal or a reversion signal. More specifically, when the 50-day moving average crosses below the 200-day moving average, this is quite often considered by the market as a bearish signal, and it could indicate that the asset has some further losses in store for it. And here we can see an example of a death cross, where you can see the 50-day moving average trend line crossing below the 200-day moving average trend line. And as you can see, the price drops significantly after that, which is not a 100% guarantee, but it does happen quite often. On the other hand, the golden cross is when the 50-day moving average crosses above the 200-day moving average. And this is quite often considered as a very bullish signal by traders, and it indicates that the asset may very well be in for some further gains. Here we can see an example of this, where the 50-day moving average is crossing above the 200-day moving average, and the price has spiked significantly upwards after that. However, you have to be quite careful with this. Trading only based on the simple moving average crossover will not turn you into an investment guru. You're not going to become the next Gandalf of the stock market. If you're about to YOLO into some FDs just like on Wall Street bets, you may be very well in for a surprise. So this was a very basic introduction to what a simple moving average is, more specifically the 50 and 200-day moving average trend lines. So if you are into it, I invite you now to come along and code with me. Down below in the description, you can find a link towards the Google Colab notebook. And if you want, you can code along and even try it out for yourself on your favorite stocks. And if you also want to learn how to calculate some other indicators, I'll leave you a link somewhere in the corner with a video that I've done previously that helps you calculate also simple moving averages, some ratios, and some different indicators on your favorite stocks. So we will start by installing the required libraries like yFinance and Backtesting that do not come as default with Google Colab. And then we will import all the required libraries that we need, like Yahoo Finance, Pandas to deal with the data frames, Backtesting, which is a very interesting library that we will use to backtest the strategy specifically, and also Plotly, from which we will be able to plot graphically the information and see the results that we're getting with our strategy. Then we will define an empty variable called ticker. This will be an input, which will say enter the ticker symbol you want to analyze. And then we will say that our ticker data is going to be equal to Yahoo Finance.ticker. And we will say that this will take our variable ticker. And then we define our price data variable, and this will be equal to ticker, the ticker data dot history. And here we will pass in an interval, and we will say the interval will be 1 hour. And we will select a period range of 200 days. We'll put in a small comment here that because this is the maximum amount of 1 hour data that we can get through this API, which is for 200 days maximum. Then we will call our price data and say that it is equal to price data.iloc from, we replace -1, so we will removing the last row. We are doing this specifically because there is unfortunately a small bug with the backtesting library for the moment. And we will call our price data to see it. And we will select AMD as our ticker, and as you can see, this returns a data frame with the open, the high, the low, the close, and the volume. Now we will define a function that will calculate our simple moving average. So define simple moving average, and this will take in a price and a period range. Oops, it says Pandas, we want period, autocompletes. And then we will return here a Pandas series, which will take in our price and will be a rolling series. And over this rolling, we'll pass in our period. So we will be rolling over our period and calculating the mean of all those prices. Next, we will define a class called SMA crossover. And this class will take in strategy from our backtesting library. And we will give it a variable called interval short term, which will be equal to our 50 days period. And our interval for the long term will be our 200 days period for the 200-day moving average. And here we will define an init function, and we'll pass in self. And we will define a variable called close, where we say that's our self.data.close. And we will say that our self.SMA short term will be equal to our self.I. And in the self.I, we'll pass in our simple moving average function, our close price, our self.interval short term, and also repeating this line of code on the bottom for the SMA long term. So we will replace here interval short term with interval long term, and we will also have to replace SMA short term with SMA long term. Next, we will define a function called next, and this will take in self. Oops. And in here, we will say that our price will be equal to self.data.close at position -1. And if our crossover that takes in self.sma short term, oops, we got here some caps here, term, and it also takes in our self.sma long term. This will essentially determine whether these two cross over. And we'll say that our self.buy in this case. So if the short term crosses over the long term, we will buy, and elif our crossover, if the crossover is our, we got a little correction here. And we'll paste this here and say that self.crossover SMA long term crosses over our short term. Then in this case, we will check if we have a position. So if self.position without the brackets, then self.position.close. So we will do a buy only strategy. We will not go short. Next, we will say that our backtest is going to be equal to our backtest from our backtesting library, and we'll pass in our price data frame. We'll also pass in our SMA crossover function, and we'll say that our cash, our initial cash, will be, let's say, $10,000, and we'll say that our commission, the commissions that we pay per trade, will be equal to, let's say, realistically 0.2%. And we'll say that the orders are exclusive. So exclusive orders equals true. We'll say that our output will be equal to our backtest.run. Or rather, we can actually put this into a data frame, and we'll say that our data frame will be a Pandas data frame, and we'll pass in our backtest run into it. So like this, we can visualize it as a data frame instead. And let's call in our data frame. And as you can see, this returns the result of the strategy quite nicely. So we started on the 7th of April 2021, 200 days ago, until the 19th of January 22, so 287 trading days. We were exposed for about 58% of the time. Our final equity ended up to be 15,276. As you remember, initially was 10,000 in cash. Our equity peaked at 19,500 roughly, and we had about a 52.76 return, which is slightly below the buy and hold if we just bought and hold this asset, which is 57.73% return for the same period. Our annualized return is about 70.55%. Volatility for this period calculated annually would be around 59.68%. Our Sharpe ratio is about 1.18, Sortino ratio about 3.52, and the Calma ratio was about 3.1. We can also see that we had a max drawdown of about 22%, so that was the worst drawdown that we had, holding a bag a bit, and our average drawdown was about 2.91%. Our max drawdown duration was 83 days, so we held the bag for 83 days, and with the average drawdown duration was about 6 days. In total, for this strategy, we had about 3 signals, so we did 3 trades. Our win rate was 66%, and our best trade was about 30% return. The worst trade gave us a 7.5% downwards negative return, and the average trade percentage gave us a 15% return. Over these 100 days was the max trade duration we ever had. The average duration was 55 days, our profit factor 7.57, and we had about 16.5% expectancy return per trade. So we actually don't need this cell, so we can delete it because we already stored it in the data frame above. So let's start by calling our backtest.plot, so we can plot this information now and see it visually. And there we go. This gives us a fantastic plot. As you can see, it gives us our peak And our final equity levels, our max drawdown, you can see the different profits and losses that we had, the 3 trades on, and that red line here, which was the 82 days of max drawdown that we had, the max equity level that we had in that little blue ball, and we ended up at 153% equity, so 15,000, slightly over 15,000 cash. You see here the profit and losses that we have, the 3 trades, so 2 of them were profitable, the green ones, and what they get returned, and the small loss we had of 7.5%. On the graph here, you can see the 2 trend lines and the price, and you can see in green and in red where we've entered the trade and for how long. So the 2 trades are quite long term. As you can see here, the trades, we exited the trade when the 50 days crossed over below the 200-day moving average, and here we did another trade, which we exited again when the 50-day moving average crossed over, and here we had another trade that was not a very good signal. So the 50-day moving average crossed above, we bought, but the market reversed, and we made a small loss there. And obviously, we closed the trade when the 50-day moving average trend line passed below the 200-day moving average trend line. Just for a quick comparison, we can also calculate and plot what the RSI would be like for this versus the SMA strategy. RSI stands for Relative Strength Index, so what the signals were in the relative strength index for this period relatively to what the SMA strategy showed us as signals. So we'll define a new function called calculate RSI. And this will take in closing prices and a look back period. And here we'll say that the delta will be equal to our close.diff, and that our up will be an empty list, and our down will also be an empty list. And here we can do a little for loop and say that for I in range for the length, the length of our delta, we'll say that if the delta at position I is smaller than 0, then our up dot append a 0 to it, and our down dot append our delta at position I. And else we want to do the exact opposite of this. So if the delta at position I is bigger than 0, we will obviously up dot append delta at position I, and we will to our down list append a 0 to it. And small correction here, it's not vertical brackets we want. There we go. And now we'll say that our up series will be equal to a pandas.series, which takes in our up, and our down series will be a pandas series that takes in our down list. And we'll take the absolute values of our down deltas. Now we'll say that our up exponential moving average will be equal to our up series, and on top of this we'll use the EWM function, which is the exponential moving average function. We'll give it a com equal to our look back periods, and we'll subtract 1 from this. And we'll also say that our adjust will be false. And we'll take the mean of this series, and then for the same thing for our down exponential moving average, which will take in our down series, upon which we also calculate the exponential moving average with the same look back periods, -1. To this, we'll also pass in that adjust will be equal to false, and we'll calculate the mean on this. Give us the mean downwards exponential moving average. Then we'll say that our relative strength will be equal to our up exponential moving average divided by our downwards exponential moving average, and our RSI will be equal to 100, and from this we'll subtract 100 divided by our 1 plus relative strength that we just calculated above. and this with a small s. Then our RSI data frame will be equal to a Pandas data frame. And to this, we will pass in our RSI. And we'll rename our column at position 0. We will rename it to RSI. And we'll set the index to our close.index, which is essentially the dates, the periods from which we are rolling over. And we'll say that our RSI data frame will be equal to our RSI data frame. And we will drop all the NA values that we have in our data frame. We'll finish this function by returning our RSI data frame. And we'll make sure to slice it and only take it from the third row onwards. Then we'll say that our price data RSI, we'll add a new column RSI to our price data frame, and we'll say that that will be equal to our calculate RSI function, to which we will pass in our price data closing prices, and we'll give it a rolling period of 14 days to calculate the exponential moving average upon. And we'll say that our price data will be equal to our price data, and we'll drop the NA values again. And to finalize, we'll say our price data will be equal to our price data. And we'll say iLock, and we'll keep only from the 14th row onwards. This is essentially to make sure that we skip the first 14 days to have only real values kept into consideration. And we'll end up this by calling our price data. There we go. It gives us our data frame. As you can see, we have a new column at the end there, which shows us our RSI values for each period. So we only have to finish this up by plotting our RSI data now. So to do that, we will use Plotly, and we'll say that our figure will be equal to go.figure, and we'll say make subplot, and we'll give it a one row and only one column, and we'll share the x-axis between them. We'll also say that we want a vertical spacing with a small s here of approximately 0.05. Then we'll say that our figure.add trace, and in here we'll pass in a go.scatter, and our scatter plot will be equal to x. Our x-axis will be the data frames index, and then our y-axis will be our data frames RSI. To plot our RSI levels, we'll give it the name of RSI and a marker color of, let's say, gray. We'll assign this to our row 1 and column 1 of our figure. And now that we have our RSI plotted, we need to plot in the two levels. So we'll say that fig.add trace, and this will be again equal to go.scatter. And in here we'll pass in that our x values will be again our data frame.index, and our y values will be, in this case, we'll pass in 30, and we'll multiply this by the length of our data frame.index to replicate it, and we'll give this a name of oversold. This will be our oversold level if it drops below 30, and then we'll give this a marker color of red. We'll also have to give it what type of line we want. So here we will want line to be equal to dictionary. We'll pass in a dash, and dash will be equal to dot, so a dotted line with a width of 5. And we'll say that we don't want to see this in the legend, so we'll say show legend equals false. We'll also assign this to our row 1 and column 1, so it all shows up inside the same plotted frame. Now we'll copy this and we'll replicate this again because we want our 70 level line, the overbought line. So essentially we can replace this with overbought, and here we'll put in 70 instead. And we'll finish this by saying figure update layout to give it a few layout definitions, and we'll say that the title of our plot will be RSI. The title font size, we'll give it a font size of, let's say, 26. We can also say that our title x-axis will be 0.5, and the y-axis title, we give it an RSI title, and we'll choose a template for this plot where we'll say plotly dark to have a nice dark background, and we'll give a height to our plot of 800. We can finish this by calling our plot, so fig.show, and we execute this. There we go. We have the two dotted lines for the overbought and oversold levels, and it shows us nicely where the relative strength index trend has crossed the oversold and the overbought signals. So if we look at our previous graph, you can see our first trade we entered at around, let's say, Wednesday, June the 2nd. And our second trade we entered around, let's say, Wednesday 13th or Thursday 14th of October. So if we look at where we were on June the 2nd, we were around here. So as you can see, it's not an ideal level to enter the trade if we look at our relative strength index, because we've bought where the relative strength index has shown us that the asset was still at or very close to an oversold price level. 68, not ideal. And then for October the 14th, even worse, we've essentially entered the trade at a way overbought level, and we can say it was quite above. So as you can see, the simple moving average strategy does have some flaws, because if you only base your strategy on this simple trend, it might happen that you incur losses. So if we look at this specific trade here, where we exited on the 6th of Jan, a trade that we actually started on Thursday, the 30th of December, if we look at that on our relative strength index, you can see that we've bought, if we magnify this here, the 30th of December, there we go. We've bought, again, here, both of them looked like a buy, but then the asset obviously dropped and went into oversold ranges after the fact that we bought. So it was a losing trade, which we ended up closing after the 50-day moving average trend line passed below our 200-day moving average trend line. If we magnify this here, as you can see, on the 3rd of January, we went into an overbought range as well. So as you can see, the simple moving average crossover strategy does have some drawbacks. If we compare the relative strength index and its signals to what the simple moving average crossover strategy signaled to us, it's quite questionable whether or not we should have entered those trades. What this means is you should never base your trading strategies on one simple indicator. It's always better to take into consideration a range of indicators. As an example, you could take in simple moving average crossover or an exponential moving average crossover strategy. You could look at RSI, you could look at MACD, you look at standard deviations, at oversold levels, overbought levels. You could look at the volume traded as well. And also, it's very important to not only take into account technical indicators, because technical analysis alone is not always enough. You should also do some fundamental analysis by looking at the macro environment, such as are there any macro events happening in the near future that may not be fully priced into the market yet? For example, I don't know, looking at today's news, interest rate hikes that might be upcoming, if it's, for example, 2 or 3 or 4, that might have a different weight on the market. other things like macro level events that can have an impact on the on the market, such as Russia taking any actions on Ukraine, or China potentially taking any actions on Taiwan, or the US and China, or US and Russia relationships deteriorating. That can also have an impact on the market. Inflation levels, unemployment, jobs, news, earnings, upcoming earnings as well. For this specific example, we were using AMD. So AMD has earnings coming in a few days. That also increases volatility. And depending on the expectations on earnings, the stock prices might also move up or down, especially when those expectations adjust. And more specifically, after earnings, if the earnings are not in line with what the expectations were, that can cause a reversal in the trend. For example, if a company ends up declaring earnings above what the estimated threshold was, it's very likely that the stock price adjusts and has an upwards movement. Whereas on the other side, if earnings end up being below what the estimation was, then it's very likely that the stock price adjusts and moves down. So I hope this wasn't too confusing for you guys. As a quick update, as promised on this channel, I've been working on a website, or rather website/web application that is going to be working as kind of a Twitter/trade tracking system for my options trading. This is interesting for whoever trades options, more specifically wheels, leaps, iron flies, iron condors, some debit or credit spreads, as it allows you to track your cost basis. I'm thinking of sharing the whole process of building this website on a live streaming kind of series, where I will stream it live and then I will take parts of those videos and create an entire series on this channel, kind of a semi-live stream / tutorial videos where you can learn how to work through Plotly, Plotly Dash, specifically to create quite easily web-based applications and websites, how you can interactively create bootstrap components in them, which creates this nice design for your website, and how you can manipulate different styling and different figure combinations, and the whole back-end to front-end. So namely user configuration, user sign-up, logins, logouts, password resets, email authentication, and all the way to database management, where I'm going to be looking into a bit of SQL and NoSQL databases as well, to keep track of all the trades and some of the trends that are coming in, and some of the stock information that we want to keep static on the website. And it will also have some tutorials on it. And I hope this is interesting for you guys. It's going to be a quite long series, so there will be quite a few videos because it's a quite big project that I've been working on. And I hope you guys enjoy it. So stay tuned for that. And if you like the content of this channel, again, please drop me a like or a subscribe. It helps a lot with the YouTube algorithm. And again, thank you to all of you guys if you have already done so. It helps out so much. And thanks for following me as well on my social media channels. All the links for those are in the description below. If you have any comments, any feedback, or any requests that you would like to have for any upcoming videos, feel free to leave them in the comment section below. You can always also contact me through LinkedIn or through Instagram. And as always, see you in the next one.